Is everything hunky-dory in the banking sector? Hmm, don't bank on it.
It's Lee. It's Lee. Lee.
Hey everybody, hope you're doing well and looking after yourselves. Welcome to Lee Learns. I am of course Lee. I mean, it would be weird if my name was something else, right? Anyway, so interesting topic today. Before we get started, like, subscribe, share, leave a comment, do all that really cool stuff. Really do appreciate it. So today's topic is going to be about these recent bank issues that we've seen. So the collapsing, the Silicon Valley Bank. I think there was another one, Signature Bank. So first of all, I'm just going to play this little video and let you guys see a little bit of what this one lady is saying, and we'll go from there.
Hello and welcome to the Kim Iverson Show. Thank you so much for watching. So Friday, Silicon Valley Bank collapsed after widespread industry panic caused a run on the bank. Now try to put your disdain for elitist Silicon Valley censor czars aside, and let's take a look at the bigger picture of what's happening because it's incredibly frightening. Essentially, the government is seeking to gain greater control over big tech, which will ultimately mean greater control over us. Now, we've seen what was revealed in the Twitter files, how the government infiltrated the big tech platform to censor Americans. We've seen how rollouts of things like ESG scores are being used to force companies to comply with a certain agenda or else. Now, the government seizures of Silicon Valley Bank and subsequently the Signature Bank of New York should set off loud, blaring alarm bells. Over 90% of tech startups bank with Silicon Valley Bank. And interestingly, Coinbase, the largest crypto exchange in the US, just announced mere days ago its move to Signature Bank of New York. And then the government seized it. You want to control someone? Control their money. And do you know what the government blatantly states they want to do? Control big tech and control crypto. Coincidence? It's important to understand that Silicon Valley Bank was not insolvent. It was illiquid. There's a difference. Illiquid means it couldn't come up with the cash customers demanded at that very moment. And the reason they couldn't was because suddenly about 20 to 25% of the money the bank managed was being demanded by customers all at once. Now, no bank in America could handle that sort of demand. Any bank would go under in the event of a run of that magnitude. Unlike the banks in the 2008 crash, SVB didn't invest in risky assets or make bad loans with its customers' money. It actually did one of the least risky and supposedly safest things you could do with excess customer cash. It bought treasury bonds. Treasury bonds are guaranteed if you wait till maturity. Now, lots of banks hold bonds. In fact, the Fed recently encouraged banks to buy them rather than lend customer cash.
So an interesting video there by Kim Iverson. Some people have said that this is inaccurate. Other people have said that it's actually quite true. I'll sort of run through what I think of it, but it's kind of interesting that she did mention about how all these people wanted their money at once. So 25% of people, I think it was something, and that causes the banks to pretty much, oh crap, can't really accommodate that. So, which if you kind of think about it, the whole thing about banks is IOUs. When they have your money there, they actually don't have your money there. It's actually they're giving you an IOU. So if you need to check that out, check that out. Check out the history of money. It's a good documentary on YouTube. That sort of gives you a bit of an insight into that. So yeah, it's this whole video is kind of interesting. I just found it to be somewhat credible. And if we take a look at the whole CBDC, which is the central bank digital currency, and how it all occurs with that, it kind of makes a lot of sense. But if anybody doesn't know, the central bank wants to create it. So it is actually the process. If you have a look at it's a website called Atlantic or something, I think it's called that, and they're actually have got a list of places where CBDC is actually being used, including Australia. So people who don't know that, I'll go through that pretty soon. But before I do anything, I just want to go through this timeline of the bank failure, and then we'll go through that a little bit more. So all right, so here we go. Timeline of the banking crisis, or chaos, I should say. Crisis, chaos. Collapse of Silicon Valley Bank prompted regulators to move to contain the fallout. Actually, if you've probably seen it, I'm not really sure, but there was a bit of an exchange between Janet Yellen, who's the Treasury Secretary, and a member of Congress. I think it's named James Langford, I think, something. And he was saying, you're bailing out the big banks, but not small banks. That seemed to be quite the case. You didn't seem to have an answer. So March 10th, Silicon Valley Bank, one of the most prominent lenders in the startup ecosystem, collapsed. And this is actually something that's quite interesting here, because a few people have pointed out that this whole thing of a lot of the startups were crypto-based. So, of course, we've got some people who are theorizing that, well, this is a whole thing to bring in the CBDCs and discredit cryptocurrency. Anyway, the turmoil has led to the seizure of Silicon Valley Bank and Signature Bank. That was the other one I mentioned, the private sector bailout of the US regional lender First Republic Bank and takeover of the troubled Swiss Credit Suisse by its rival UBS. Suisse, I think that's how you pronounce it, Credit Suisse. That's how we pronounce it now anyway. Here is a timeline of major events that led to the turbulence in the global banking industry. March 8th, Silvergate Capital, cryptocurrency-focused bank, there we are, announced it would cease operations and liquidate its assets after a bank run forced the California lender to sell a chunk of its debt securities. Silicon Valley Bank concerned investors when it said it needed to shore up its balance sheet and raise $2 billion in capital. Of course, that's going to freak anybody out. It was forced to sell a bond portfolio at a $1.8 billion loss. And I feel that tomorrow. In a letter to customers, Greg Becker, the chief executive of Silicon Valley Bank, said the bank enjoyed the financial position to weather sustained market pressures, but he noted that customer deposits had come in lower than forecast in February. Moody's, that's a great name by the way, a credit ratings firm, downgraded the bank's bond rating and slashed its outlook to negative from stable. All right. Yes, he may stay calm. Silicon Valley could fail. Bill Ackman. Yes, I know of Bill. Billionaire investors suggested that Silicon Valley Bank could fail and need a bailout. In a note sent to clients, a Silicon Valley Bank executive wrote the bank was actually quite sound, and it was quite disappointing to see so many smart investors tweet otherwise. And of course, it's interesting if we go back to like the financial crisis, 2008, people sort of go, oh, banks are fine and resilient. I mean, that's not always true, is it? Silicon Valley Bank failed after a run on deposits. Well, of course, your stock plummets 60%. All right, so they go into receivership. With the Federal Deposit Insurance Corporation. The failure of the 40-year-old institution became the largest bank crash since the 2008 financial crisis, and it put nearly $175 billion in customer deposits under the regulator's control. And of course, that led to dumping of bank stocks, which is First Republic, Signature Bank, Western Alliance. Here we are, Janet L. Yellen reassured investors that the banking system was resilient. Yes, don't think so. Not entirely, anyway. Signature Bank, a 24-year-old New York-based institution that lent largely to real estate companies and law firms, saw a torrent of deposits leaving its coffers. So, obviously, that's connected to the other one. There's not much here in the Signature Bank about cryptocurrency. So, a lot of people putting it down to that, but obviously The signature bank doesn't really have that as much, and it's not mentioned anyway. Prevent the spread of banking contagion. Regulators seize signature bank. Yep, they'll do that. To some extent, the bank, which had 40 branches, was a victim of the panic surrounding Silicon Valley Bank. All right, yeah, obviously. All right, Federal Reserve, the Treasury Department, and the FDIC announced jointly announced that depositors will have access to all their money starting Monday, March 13. No losses from either bank's failure will be borne by the taxpayer. It's funny, the Federal Reserve, as mentioned in that video, they're like one of the hugest financial institutions. They're actually quite profitable, and they had the ability to actually bail out these banks, and apparently saw that opportunity and decided, I won't bother, which actually is kind of interesting to me. The FDIC invoked the systemic risk exception, which allows government to pay back uninsured depositors to prevent dire consequences for the economy or financial instability. Set up an emergency lending program with approval from Treasury to provide additional funding to eligible banks and help ensure that they were able to meet the needs of their depositors. Holy hell. Now we got President Biden in a speech said the US banking system was safe and insisted taxpayers would not pay for any bailouts. No losses will be borne by the taxpayers. Yeah, so we're First Republic took a beating, dropping 60%. Oh, okay, yeah. HSBC said it would buy Silicon Valley Bank's British subsidiary. March 14th, bank stocks recovered some of their losses. Justice Department, the Securities and Exchange Commission reportedly opened investigations into the collapse of the Silicon Valley Bank. Shares of Credit Suisse tumbled by 24%, a record low. All right, Wall Street, the S&P was down by 0.6% at the close of trading, reversing some of the previous day's rally as investors' fears over the health of the banking industry resurfaced. It's all tied to confidence. That's pretty much it. Let's see. First Republic Bank received $30 billion in deposits. It's nice that all these are able to get money, but it doesn't really happen for ordinary people. Hey, I need money. Huh? Not giving you a bailout. Credit Suisse told it would borrow $54 billion from Switzerland's central bank. All right. Federal Bank announced that as of Wednesday, banks have borrowed $11.9 billion from emergency loan program. March 17th, the shares of many banks continued their dizzying slide, erasing gains from the day before. Their First Republic, the beleaguered regional lender, on Friday lost a third of its already depressed value. Then, of course, we got UBS on March 19th taking over Credit Suisse for $3.2 billion. And Swiss National Bank agreed to lend up to 100 billion Swiss francs to UBS. Federal Reserve and five other central banks took steps to make sure dollars would remain readily available in the move intended to ease the strain of the global financial system. And the Federal Deposit Insurance Corporation, who were acting in the receivership, I believe, said it had entered into agreement to sell the 40 former branches of Signature Bank, probably make a couple of them into a Taco Bell and an In-N-Out burger. That'd be pretty good. So, kind of interesting what's happened there. If you've seen, it just seems like there's some of the crypto stuff happening, and it's kind of an easy thing to sort of look at, I suppose. But the federal bank and all that, they have a lot of power. And I think people forget that. They forget that there's actually a Federal Reserve, and they pretty much have a lot of power. And when things like this seemingly fail, which is actually was pointed out in this video, you kind of think, all these resources, financial resources, whatever else at your disposal, they probably saw this coming and just went, they probably could have been intervened, I suppose, but not really 100% on that. It just seems very odd. But I just want to go through something else here about the CBDCs. I've got a couple of things here. I'm just going to get that back and share that again. There was this thing, advantages and drawback of a central bank digital currencies. I was actually hoping for an actual list of things. Here we go. They can provide a secure and reliable means of digital payment and remittance. CBDCs can be used for online and offline transactions that can be integrated into existing payment systems. They can have use to facilitate cross-border payments. I guess for some people, they're looking at it where it can actually be beneficial for people in developing nations, although that's why we have Bitcoin, and that's the thing there. This is the party, the drawback. They could lead to increased surveillance of financial transactions, which could raise privacy and security concerns. Additionally, the implementation of CBDCs could be costly and complex. There may be risks associated with the integration of CBDCs into existing payment systems. So down here, it's terrific. And then they can also be used to facilitate cross-border payments, which can also be, that was it up the top there. So it's down here, it says it's terrific up the top. They can be used for online and offline transactions that can be integrated into existing payment systems. All right, so, but then again, it's also quite costly, yeah. And I typed this into there before, and what privacy issues does it have? Well, they'll be able to accumulate sensitive payment and user data at an unprecedented scale. In the wrong hands, the data could be used to spy on citizens' private transactions, obtain security-sensitive details about individuals and organizations, and even steal money. So I guess they're sort of saying, if it's in the government hands, it's okay. We just don't want it to be hacked. I mean, we already get monitored enough, so I guess they're trying to tell us, hey, and this is coming from the IMF, so that's kind of interesting. Here's something. Anonymity means the central bank does not keep a record of users on the basis of a particular series of currency. Banks have records about the value of the transaction, but not details about the specific series of currency with a particular customer. Well, it's Bitcoin right there. And of course this is kind of interesting. Experts say banks' KYC norms will establish identity at the source of funds when CBDC is drawn from a user's account and put in his wallet. What RBI is tooling of his entire wallet-to-wallet trail that can potentially be tracked. So of course it can be tracked. It's going to always be tracked like that. I'll be able to watch everything that you do. And of course, Australia is one of the biggest places that this is all happening. You know, thanks to the Commonwealth Bank and I think it was the National Bank, something. Yeah, National Bank Perpetual and Consensus Software for distributed ledger technology. Wow. So kind of interesting. I'm interested to know, does anybody here that's watching this video think that there is some sort of, I don't know, was this deliberate? I'm kind of in yes and no. I'm kind of leaning towards, I think for some, I think that they saw this coming and just were like, eh. But it does help if you're somebody that's actually there and you're pushing this thing, for CBDCs, and you want that to happen. Of course, you're going to be okay with a couple of banks collapsing. And if it's something that you kind of want to go, hey, we've got a product here that is better than this product over here, well, that's going to always be in your best interest. And as is mentioned in the video, Kim Iverson speculates that trying to get people into one bank or one like a small group of banks, because it's easier to sort of control and pretty much put whatever you want in there. So you got different policies that you can actually come out and say, hey, here's something here that you can check out, and hey, we're all in this together. We're all in the same bank. So quick, check this out. Check this part out. I don't really know. It's kind of interesting though. I don't like the idea of things being tracked. I'm not a big fan of surveillance. It's all around us, of course. I mean, even this room is under surveillance everywhere. And, I'm not a big fan. I think that Australia tends to be pretty lax with all that. Like, we don't seem to really take a lot of that stuff seriously, not as much as what we could. And so, yeah, I don't think we should be looking at CBDCs, and I think we need to actually be more decentralized, to be honest with you. But that's just my view. So, yeah, I would say, like I said before, you got the resources to prevent something, and yet something goes to crap. What chances other people got? Anyway, let me know what you think. Don't forget, like I said, like, subscribe, share. I'd love to hear what everybody's thinking and what your thoughts are on this whole thing. I do have to say that it is actually quite a worry, and the banks are not as resilient as what we think, and the traditional systems are just not working. The system has failed pretty much, and you can take that to the bank. Anyway, I shall get out of here. Hope this has made some sense. And yes, I spelt sense, came from the CENTS perspective there. So sense and sense. All right. Okay, I'm gonna get out of here. Take care, and I shall chat to you later on. All right. Bye.